Kyle Bass, founder and chief investment officer at Hayman Capital Management, writes in Bloomberg Opinion today, quote, "There is speculation that Trump has told his negotiators to get a deal done in order to put an end to recent market volatility. But that would mean foregoing a historic opportunity to come to a major restructuring of America's relationship with China at a moment when China is most inclined to agree to concessions. We have come too far for Trump to take the easy way out." Kyle Bass joins us now from San Francisco. Kyle, great to see you. Thank you so much for taking the time to speak with us. I want to follow up on that opinion piece you wrote. You're saying basically the U.S. should not squander this opportunity, squander its leverage. Do you see any evidence that it's getting ready to take the easy way out?
Yeah, I think you've seen multiple press reports talk about the fact that the administration, who's done an amazing work in confronting China on many of the different fronts that the U.S. should be confronting China on, given December's market decline in the equity markets, I think that you see President Trump now potentially telling his team to just get a deal done, and I think that would be a big mistake given the amount of work that his team has done. In all the different facets of our relationship with China, to date. I think doing a deal only on trade is but a small part of the global resettlement of our relationship with China.
So where should be focused on for you to call it a success? Is it about IP? Where's the key negotiation that you want to see a deal done on?
Yeah, sure. I mean, there are so many different fronts that we need to be negotiating on. Number one, the Chinese steal roughly $200 to $300 billion a year of IP. It's hard to put a number on it, but whether you look at the Defense Department or the U.S. Trade Reps reports to the White House, it's somewhere in that category. And then you have, industrial policy that circumvents WTO rules with subsidization of electricity and property and all the things they do on their industrial policy. And then their geopolitical assertiveness and military assertiveness in the South China Sea. And then now they've given us another thing to really think about with the internment of the million-plus Uyghurs in the Xinjiang region of China. I mean, there's so many different fronts we need to be confronting them on, and trade is so small. In the instance of trade, I think that's but maybe 10 to 20% of the argument.
That may be the case, but that involves a lot more people as well when you bring up geopolitics, for instance, and there is this March 1st deadline. What is the market pricing in here when it comes to any kind of agreement or anything concrete coming out of a China-U.S. trade discussion or discussion overall?
What I see in the market is the market's got about an 85% probability that a trade deal gets done. And we believe that depending upon how the wind's blowing that day and how President Trump feels, that might be properly priced, meaning if what happens is we do a deal on trade and we elect to defer or discuss much later all of the more difficult issues, then I think the administration gets a quote win, and the markets rejoice briefly. But when you look at the underpinnings of our relationship with China, it's at a very difficult place in its historical terms. And I think that, again, trade by March 1st may or may not happen. If the Chinese aren't willing to negotiate on some of the more difficult issues, I think Trade Rep Lighthizer and his team won't engage in getting just a trade deal done unless President Trump overrules them.
Carl, I'm interested in, say we seemingly have a relatively successful deal written out. How do you ensure that the commitment remains to uphold what has been agreed? How do you think we manage to see the change in behavior be exerted by China in the longer term?
Yeah, I mean, again, this is difficult to cover in a few minutes here in our discussion, but I think that the agreement, of course, needs to be both measurable and there also need to be potential consequences for them not upholding the agreement. The old saying goes with China is look at what they do, not at what they say, because they've said for a long time that they'll implement various policies that they've never adhered to. And so I think it's important for any agreement, again, to be measurable and also punishable to the extent that one side doesn't uphold their agreement. I mean, that's the difficult dance that we do with regimes like China.
You are a noted China bear. You mentioned in November increasing your short position against the Chinese yuan. Since then, we've seen the Chinese yuan strengthen. Why would Beijing let the yuan weaken, fall, and risk incurring the president's wrath right as the Chinese government is negotiating with the U.S. on some kind of deal?
Well, look, as you know, China purports to be the second largest economy in the world with 15% share of global GDP. But if you look at cross-border currency settlement, according to SWIFT, less than 1% of the world settles in Chinese currency. So Chinese is really just a paper tiger, or China's just a paper tiger. And I think that they have done so much work in order to prop the yuan up or the RMB up. That the funny thing is that we consider calling them a currency manipulator on the weak side. In reality, what they've been doing is intervening and strengthening their currency to hold their whole credit market together. So to your point, what is their true pile of FX reserves worth? How much money do they have in order to defend their currency before they have to let it go? And I think as China becomes more globalized and wants to become more of a real currency, today it's not even a real currency, being less than 1% of global settlement, then true economic forces will act on it, and that's when you'll see a revaluation.
What will be that tipping point? When do you think that time will come to bear?
You know, last year was the first year that China had a current account deficit, i.e. More money going out of China than coming in. And I think that they're so desperately short dollars that they need foreign direct investment, portfolio investment to hold everything together, given the extent of their credit position that they're in today. That the tipping point will be when you look at China from a macro perspective. They've got a current account deficit and they're running a massive fiscal deficit. So their consolidated fiscal deficit is a little bit north of 10% of GDP, including local government finance vehicles. Think about the US. We're now a little bit more than 4% of GDP and all the alarm bells are going off when China's at 10% of GDP. So China's starting to look like a traditional EM problem, meaning they're borrowing, they've borrowed $1 trillion in the global capital markets, Chinese corporates have. Chinese banking system is more levered than any banking system's ever been in the world, and they're now running a current account deficit. So now they're a twin deficit country with reserves that are dwindling. And so when you ask when is the time, I guess the answer is no one knows, but it sure is worsening as we speak.
Well, speaking of debt problems, there's a Bloomberg report, Caroline, about two large Chinese borrowers, China Minsheng Investment and Wintime, that missed payment deadlines this month, which just goes to the whole point of how the over-leverage is a problem in the China's corporate sector.
And the concerning thing here is that these are two highly indebted big borrowers out there. Kyle, your perspective here, how many defaults are we likely to start seeing? What sort of default cycle are we anticipating coming from China, and who does it hurt?
Well, my view is, China works in two worlds. One, they work in their domestic world where it's RMB denominated. And in their domestic world, they control the price level, they control the police, the printing press, and the narrative. China can really much control their domestic market almost ad infinitum. But where you start to see defaults are when they borrow in dollars, because they can't manufacture dollars. And so you're going to start to see them defaulting on dollar-denominated debts over time. And so when you look at the number of corporate defaults, and especially corporate defaults in dollars, that's where they're going to have a problem. If it's an RMB, they can sweep it under the rug and print RMB. You look at how many RMB they've printed since their ascension to the WTO, or more importantly, since 2009. You realize they've printed $30 trillion worth of RMB if you look at the Chinese money supply. They've printed like it's the national pastime. They've embarrassed the US, Japan, and Europe on the printing side. And so I think that's all going to come home to roost soon.
All right, well, we'll see how that all plays out. Of course, if any of that does, it would be an exogenous shock that the central bank would need to factor in as well. In December, Kyle, you called for a mild U.S. recession for later this year, late in 2019. Now that the Fed is clearly in pause mode, have you changed your outlook? Is that still your base case scenario?
Yeah, I think if you look at, I'll give you a broader answer. If you look at Asia and you look at the subcomponents of Chinese industrial production, 4 of the 5 of them are already in negative territory. If you look at Europe, Italy entered a recession, about a week and a half ago. Germany's internal numbers look like it will be in an official recession in the next 3 to 6 months. And the US has this positive stimulus coming from the tax cut that we believe had a $250 billion impact last year. It'll have a $400 billion positive impact in total this year, but next year it'll only be $150 billion, and you have to look at the deltas. So the delta from last year to this is plus 150, and the delta from this year to next is, call it, minus 250. So I think economic activity will begin to wane in the back half of 2019, and by the middle of 2020, we're most likely to be in a recession. And given let's say the conflict between the Democrats and Republicans in Congress, my guess is the Democrats aren't going to let Trump stimulate going into an election year. They're saying behind the scenes that he's taken the economy hostage and they're going to let him shoot it. And so I expect the U.S. to be in a mild recession by middle of 2020.
But as Powell and the Fed got the message, Kyle, you gave him an F in December. You said that really he'd failed, basically, certainly the emerging markets when they continued to hike. What sort of a path are they on now, and what rating, what sort of score would you give him thus far?
Well, I mean, listen, we had the worst December in stock market history, right? The market dropped at 1.16% in a month. Think about this, the month they took Lehman down, when all the U.S. banks were insolvent, Lehman had come down worrying about AIG, we lost a little more than 10% that month. We were down 16% in December. So, you know, the reason I'm giving the central bank an F is look at what's happening in China and Asia, call it Southeast Asia. Look at what's happening in Europe from the economic perspective. The U.S. stimulated at full employment with our tax cuts. That stimulus is about to wear off. What I worry about is the last 3 recessions we've had in the U.S., we've cut rates 500 basis points. Now we can only cut them 225 or 250. And what was it, like a week or two ago, the San Francisco put out a white paper about the benefits of negative interest rates. You know, I hope that's not where we're going, but we can only cut rates about 225, 250 bips and to be at 0. So this point of normalization should have happened long ago, not now. So they were really late in the cycle in raising rates, and now they're stuck. And so when we get into even a small recession, I don't think we have the arrows in the quiver. And so let's hope that we learn something from Japan and Europe about negative interest rates. They destroy the banking sectors, and they have not helped their economy whatsoever. I don't think that's the place we should go. But I guess what I'm telling you is sometime in 2020, interest rates could be a lot lower than they are today in the U.S.
So a final question to you, Kyle. When it comes to U.S. stocks, do you think it's more likely that we will get a revisiting of the September highs first or a revisit of the December lows first?
Oh, I think there's look, there'll be the markets will rejoice to the extent that we get to, quote, a win on a trade deal. It'll be short-lived. My guess is by the end of this year, U.S. market will be lower than it is today.